Alright, what is up guys? Hope you guys are doing alright. I got another video right here, part 5 of the series, and this one I'm going to be talking about trade management and just kind of how I do it with the way that I trade, right? And so I have it split into 4 main parts here, but 5 parts total. We have the break-even system that I like to follow, the take profits, stop losses, what I do with SMTs, and then if I ever like to use a trailing stop loss. And if you guys don't know what some of these things mean, like you might not know what an SMT is, you might not know what a trailing stop loss means, don't worry, I'm going to be talking about it in this video and you guys are going to learn, all right? All right, so we're starting with the first topic here, which is break-evens, okay? So what I like to do for my break-even system is I like to move my stop loss to break-even at points of rejection. And the main point of rejection where I like to do this is internal highs and lows. Next we have if we're targeting, a certain draw that's way up here, as my main draw, but then we have kind of a, first draw down here that price could reject off of. I might go break even there. And then the fourth or the third one here, which doesn't happen as often, but also gaps sometimes. And if you guys don't know what I mean by a point of rejection, it is basically just a spot where price can reverse off of and do the opposite of what I'm wanting it to, what I'm wanting it to do, right? So for example, here I take my entry, we got our drawn liquidity up here. This internal high would be a point of reject here. Let me actually, hold up. Let me do that. Looks a little better. Just for sake of example. This internal high right here would be a point of rejection. And so if I'm targeting up here, once price goes here, I will move my stop loss to break even, because what can happen in this situation is instead of price, continuing once it gets to this point and continuing to my draw, what it can do instead sometimes is actually just invalidate your trade idea and go somewhere else. It could go, wherever, it doesn't matter, but it's going to do the opposite of what you're wanting it to do. And there could be a few different reasons. Either one, your drawn liquidity was just incorrect. Two, you just didn't get a good entry. There's probably other reasons as well. But those are the main reasons that this can happen through my eyes, right? And then what do I mean by first draw here? If I'm targeting, we'll say shorts for this example, I'm targeting something down here. This is my draw that I really want to see price hit, but we have kind of another first draw right here that price could reject off of. And I'm in a position, just for sake of example, we'll say like this. I might move my stop to break even once price actually takes the first draw, because in theory we could get a liquidity sweep, and instead of continuing to my main draw on liquidity, we could just reverse off of this draw right here. And it's kind of similar to an internal high or low, but not exactly. And then gaps, I can show you guys in a minute. I'm going to give an example on the charts for all of these. So let me go get some examples ready for you guys. All right, so this is actually a good example of what we want to happen and kind of how I would manage a trade here. So let me play this out for you guys. You can see we're kind of, we're starting to be bullish here. We get, a strong, okay, wait, let me go back one. Hold on. Okay, yeah. So here, structurally, you guys probably recognize this. For sake of example, I'm kind of ignoring some other context, but I would take my entry right here. I would play my stop loss down here, which I'm going to get into in a second. I'm going to get into why I would do this. And then my take profit would be up here, right? And so in this example, the internal high is right here, right? It is an internal high because it is kind of just it's a higher high that we made on our way to the drawn liquidity. This would be the external high that I'm targeting, and then this would be the internal high that is just kind of a part of the move up, right? I hope that makes sense to you guys. All these will be, price is going to look like this. These are all going to be the internal highs, and then our external high is going to be the drawn liquidity, right? The thing that's way up there, the 4-hour or hourly high that we're targeting. And so you guys can see here, right now my stop loss is still down here. And what happens here, you guys can kind of see we kind of reject this area, right? We wick up into it. We don't get a strong close above it. We come up here again, we wick it again, and then we start to reject a little lower. And so if you guys remember right here where I was talking about my break-even system, you guys can see in parentheses here, mechanical with question marks. Is my break-even system mechanical? It's not these days, but when I was learning to trade and when I was just getting into it, yes, it was, right? So what would happen is I would be break even at this point because price swept the internal high. We did not close above it. These days, sometimes I wait for us to get the close above it before I move my stop to break even, because what can happen sometimes is price will go up, it'll go tap your entry, like it'll reject the internal high, but then it'll still end up going towards your take profit, right? And so over time, you can collect data and you can see whether you should wait for the close above or if you should do it just off the sweep. But usually when we get the close above, it signals that we're probably going to go to the draw for sure. But what can also happen when you don't go break even off of the sweep here is price can reject, right? Like I said, it's a point of rejection. Price could just reject here and you would never get your chance to go break even. If you're waiting for the close above in this situation, if price wanted to go back down here, you're not going to be able to get your break even off. Your stop loss is still down here. But if you did decide to move your stop loss to break even because you have a mechanical system where you go break even at the sweep of the high, then you would save yourself a loss in this example. Hopefully that made sense. I might have said the same thing a few different times there in different ways, but yeah, you can see you would have gotten break even in this example, unfortunately, and it would have played out to your draw. So this basically happened to me enough times that I decided, okay, let me not have a mechanical break-even system. Let me be a bit more discretional with it. And so now I don't always go break-even right away when we sweep the internal high. It really just depends on the trade. And I can talk about this in a later video where I'm talking a bit more about discretion. But yeah, for now, I recommend to you guys go break-even at the sweep of internal highs. In this example, you would have gone break-even. Which kind of sucks, but you guys can change this over time as you collect data, as you journal your trades. You can see how many of your break evens are actually ending up winning and how many of them actually end up losing. That's kind of how you can decide. If most are winning, don't go break even on the sweep of the high, right? If most are losing, then yeah, okay, let's go break even. Let's keep doing what we're doing because you're doing good. You're avoiding losses. So yeah, this is an example here. Okay, so right here, for example, you can see we're super bearish. We're thinking, all right, let's go ahead and target this low down here. Or actually, no, sorry, I had this one marked up. Let's say we're targeting this low right here. As you can see, we're super bearish. And I'm just going to show this on this time frame just for the sake of example, but this could be the case on any time frame. It's typically going to be on the time frame that you're executing, right? So if you were executing on the 1 hour, it would be the same rule on the 1 hour. But we're executing mostly on the 1 minute and the 5 minute. Okay, just so you guys know, and I'll you'll see that as I get into the later topics of trade management. But you can see here, what do we have? This is our internal low, right? Because this is kind of just it's the lower low of the leg down, and then this is the lower high of the leg down, right? Lower high, lower low, lower high, and now hopefully a lower low that can take the draw, right? So let's just say we take our entry right now, we play a protected stop at the higher low, because in this case, if our drawn liquidity is correct, we're not going to go above here because it's protected. And again, I'm going to talk about that shortly. And so what do we see here? Okay, we wick this right here. And so the instant that we wick that, the instant that we sweep it, we would be moving our stop loss from down here up to break even so that, we avoid a loss, right? And so what ends up happening, we wick the internal low. Maybe we're not going to deliver to our actual draw here. Let's see. Nope, you end up getting break even, but what do you do also? You avoid a loss. So that's the goal of going break evens. It's just to avoid a loss, right? So yeah, hopefully that makes sense. That's kind of my break-even system for internal highs and internal lows. All right, so now I'm going to show you guys what I mean by going break even at the first draw as our point of rejection. Okay, so in this example here, you can see we swept out some lows, so we're thinking, okay, maybe we're gonna flip bullish now. What do we end up doing? Get a pretty strong flip here. You can see we have this hourly gap. What do? We actually get an hourly inverse. Okay, we're probably gonna be bullish. We don't know for sure, but let's just say we're going to be bullish here. So let me play this forward a bit. All right, let's say we like this right here, right? Let's say we see something nice. We have our draws up here, right? This is really the main draw that I want to get to. I'm trying to get price up to this draw, but we also have this draw as well. And I think, let me see on the 4-hour here. Okay, well, yeah, this is actually an even better example because this happened to me, I believe. When was this trade? I think I actually took this trade a few days ago, but let me see here. But let me show you guys. We have two 4-hour highs here, right? We have this 4-hour high here. Ignore this one. We have this 4-hour high, and then we have this one. This happened during New York AM, I think, this week. I can't remember exactly, but we have this high, and then we have this one. Okay. Ideally, we get up to this one, right? Because I'm thinking we're going to be bullish, but we need to also be aware of this 4-hour high as well because price could reject it. So we scale down. We look for our entry. Let's see. Let's just hopefully something. Okay, perfect. I went forward. One too many there. Okay. But let's say we like this as our entry, right? We play a stop down there. We have our target up here. But don't forget, we also have this first draw here, right? We're looking super bullish. We get a nice little retrace, pretty strong flip here. We want to target up here. What ends up happening? Let's see. Hopefully we go up there. Okay, so we take the draw, right? At this point, you know, we're still bullish. I still want to see us go up here and take our primary draw, but we did technically sweep that first draw here. So what would I be doing? With my stop loss at this point, I would be moving it to break even. And let's see what ends up happening. I believe it gets super choppy. Yeah, boom. We get break even and hopefully stopped out. Yeah, so bang, you can see right here, it actually ticked out our stop loss as well. So going break even in this situation would have saved you from a loss. Let's see, does this eventually play out? Yeah, so it does eventually play out, but it did save us from a loss, right? You can see we had our stop loss right at this low here, and we sweep the first draw, and then it stops us out. And now there's ways to avoid this. Sometimes if you have a good high time frame read, you can take it off of a even higher time frame, you know, maybe an earlier entry, play a bigger stop. But, you know, if we played too big of a stop, it would be negative RR, right? So, yeah, this is a pretty good example of why I like to go break even at the first draw, even if the second draw is pretty strong, and even if you really do have strong conviction it's going to get hit, it's still worth going break even at the first draw in my eyes. This is a perfect example of, you know, why this actually happened this week. So yeah, I think this is a good example. It happened on Monday. This was during AM actually. I remember this day. It was very choppy. I did end up catching longs on my evals here, but not important. But yeah. All right, so my next example here, or the next point of rejection actually, is gaps, okay? So we went over internal high, internal low. We went over the first draw, and now we're going to go over gaps, okay? So this is a good example because it also just happened literally an hour ago or something like that. I took a trade during Asia. So what do we see here on the hourly? We are super overextended. We have dumped 600 points without really a proper retrace into any sort of high time frame gap. What do we see here? 1 hourly gap right there, and then another hourly gap up here. So since this move is so big, I feel like I mentioned this maybe in one of my other videos, but you want your retrace to be relative, you want the size of your retrace to be relative to the size of your move, right? So in this case, justifying this whole move by simply retracing into this tiny 1 hour gap is not good. It's not significant enough in my opinion. We would need to see a bigger retrace into this hourly gap and then deliver to these draws, right? Because this is like the main draw, right? But like I said in the draw and liquidity video, you can target other draws as well. This was my draw and liquidity for the trade that I'm about to show you guys, but I needed to be aware of this gap right here, because in theory, you know, we could just reject out of this and deliver to the draw. Now, do I think that our big move can be justified by this small retrace? No, not necessarily. I think it's not probable, but it is possible, right? Nobody knows exactly what the market is going to do. But anyways, we can see here, I'm going to go over my trade idea here. You can see we're finally starting to slow down. You can see volume is starting to slow down. We're wicking a bit in here. Hopefully I don't play too far ahead here. Okay, yeah, perfect. So I believe I took my entry right around here. I took it off the 5 minute, but I think it was also a 15-minute close. And so what I'm targeting is this gap up here for about 1.5 R, okay? And what ends up happening, I'll just go to the 1 minute for sake of example. But in this case, what's going to be my break-even point? The gap, okay? In this case, this first gap is going to be my break-even point. This drawn liquidity for the example, it just happens to be another gap, but it could just be like an hourly high or low as well. It doesn't need to be a gap, but this would be my break-even point. This being a gap is irrelevant. Maybe that's going to confuse you guys. So we'll just say I'm targeting an hourly high up here, okay? Me explaining the whole retrace thing, that was just to give you guys some context and the idea behind the trade, but it doesn't matter for what I'm trying to explain here, which is using opposing gaps as break-even points, okay? If I'm targeting longs, you know, and there's a bullish or there's a bearish gap in here, we could hold the bearish gap before getting up to my drawn liquidity, right? So what ends up happening here, play it forward a bit. And so I believe a bunch of volume comes in a second here. Okay, yeah. I don't know where that came from, but what do? We get into the gap. So now what do I do with my stop loss? I take it from down here and and I move it to break even, right? You know, I still think that my trade idea is pretty good. I still think we need a bigger retrace than this to justify this big of a move down. But this isn't a trade review, so let me just show you guys this. We get into the opposing gap. We get into the bearish gap when I'm targeting a bullish target. What ends up happening? Okay, we go down. I believe. Okay, I actually don't know what ends up happening. We might not even be able to skip forward enough to see me lose the trade. Okay, no. This is as far as price got. But anyways, you can see I would have gotten break even here. And what do we also see? Price starts slowing down, right? Price starts slowing down. So maybe my draw is actually not correct. Maybe we are just actually going to hold this gap here. Hopefully that one wasn't too confusing. The gaps one, you guys probably do not need to even think about this one too much. You know, I just started really thinking about it recently. It's not something that's going to be super significant and relevant. But it does happen, as you saw in this example, which is a real trade that I just took a few minutes ago or an hour ago, whatever it was. So yeah, that's kind of how I handle break evens. And so now let's get into, I guess, where is it? Take profits and stop losses. Okay. So yeah, this is a pretty important one. I have not gone over, well, I kind of did already go over take profits, right? The take profit is going to be your drawn liquidity, right? We already went over drawn liquidity. That's where I'm always setting my take profits. But as far as stop losses go, I have not gone over those yet. So let's get into it. All right. So by protected stop loss, this is what I mean. So it is most obvious to see what I mean in these trending markets because you know, this is what we strive on as continuation traders, is trending markets. We could be trending up, we could be trending down. It doesn't matter. I should probably do a actually bearish example here, because most of my examples have been bullish examples. But let's see if I can find, well, we don't really trend down that much for too long of a time, just because that's how markets work, or these markets. But here's a good example. So you can see we are in a downtrend here, where we are starting to trend down. And what do we do when we are trending downwards? We're making lower highs and lower lows. Okay, and I ran out of space there, but here we are making lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, and lower lows. And so when we are trending, when we have a strong trend, and you know, as I said in the draw on liquidity video, I believe I said, and I believe I wrote this on the screen, I said I assume that the trend will continue, right? And so in this example, if we are assuming that the bearish trend is going to continue, that means that we are not going to come up and sweep out any of these highs, right? These are not going to be probable draws on liquidity. We are probably not going to go take these out. And so this is somewhere where I would want to have my stop loss, right? At a protected high in this case, since we're taking shorts and we are expecting, you know, bearish price movement, we would put our stops at a protected high like this one. And so, you know, you can see this on the charts right here. What are we? We are bearish. And so where would I be putting my stops in a lot of these trades? Above these highs. And what do we see? These highs are not getting swept. Look, right here, good example. People who took longs to up here got cooked, right? They saw the 1 hour inverse. I can't tell if we actually inverse it. Okay, yeah, we do technically inverse the 1 hour gap. And so people are thinking, okay, we got to be bullish. We got to be bullish. No, look at the higher time frame. Look at the trend. I assume that the trend is going to continue. What are we? We are bearish. So this is protected. And what do? We do not go out and take it. We do not go and take out this draw because we're bearish. Okay. And what do we put in since we failed to get up there? Another protected stop, another lower high. We come down. What do? Okay. We can see here, we finally start chopping around, and you know, this is kind of more choppy, but when we are clearly trending, these you know, that's what a protected stop is going to look like. You can see it didn't work there, just because well, we're in a huge gap here, so that could be part of it. It doesn't matter. Point is, that's what a protected stop is. Those are the places that I'm going to want to put my stops. So if we go, let's see here. You know, this is a good example. Let's say I'm targeting shorts. You know, we get our retrace, and what do we see? Strong flip. Strong flip. This would be our entry. We take it at the closure of the strong flip. We put our stop above the protected high. Because if our bias is correct, if our bearish draw on liquidity, which is, you know, somewhere throughout here, is correct, then we are not going to go back up and take out that high. And so what do you see? We don't go up there and take out that high. Now, what would have happened, you know, if just, for example, our draw on liquidity is down here, you would have gotten break evened, because that's my break even system. Now, this trade isn't taking into account other context and factors in the market, but it's just a good structural example here. We get a retrace, strong flip out, and then we sweep out the internal low. You go break even, and unfortunately you get break even before we do end up delivering down to our draw here. So yeah. All right, so I got an example for you guys right here of a trade that I took a while ago, but I think it's a good example of using a protected stop, right? So what do we see here? Price is flipping bearish. We make a lower high. We come down more. We get our retrace, and what do we form? A lower high. And I see that we start displacing out of our 1 minute gap here. So I take my entry mid candle, and it ends up playing out to our draw. But what did I do here? I made sure that I could get a protected stop loss because I put it above this lower high here. Does that make sense? I hope it does. I don't know why I asked that. I guess I thought I was on a call with somebody, but yeah, you can see here, we start trending bearish. We put in a lower high, boom, entry, and it plays out. So this is a very simple example. I guess I can look in here if I have another good example. I mean, yeah, I guess this here we can look at this. This is from like December. But what do we see here? I'm expecting us to be bullish and continue up to these draws. I get my retrace and I get my flip. I enter, and where do I put my stop? Okay, this is actually bad stop. This is when I was unprofitable. Where I should have put my stop is down below this low right here instead of just in the middle of some candle in the middle of nowhere. Here, look, I'm learning from my journal here. I'm critiquing my old trades. This is good. Some of you guys are probably putting your stop loss somewhere like this instead of somewhere like this. And in this case, it did work out. It did end up playing out cleanly, luckily. I want to see if we have we're in the winners chat. Let's see if we have an example in the losers chat here of a bad stop loss that is not protected. I think most of these, okay, right here. This is a pretty good example. So what ended up happening here? Okay, I don't know. Okay, wow, I'm targeting absolute bullshit here. Doesn't matter. What month was this? Oh my gosh, October. Okay, yeah, so this is when I was down bad. But you can see here, I guess we'll try and look at the good things about this trade. My drawn liquidity was correct, right? My drawn liquidity was correct, so that's good. Where should I put my stop? Or why did I get stopped out? It's because my stop loss was not at a protected high in this case. I was looking at a bearish target, and I did not put my stop loss above a protected high. And so what actually ended up happening, we come down towards my draw. We have our high up here. We come down towards it. What do we put in? We put in a higher low, and then, this is our lower low. We put in our higher low, and then we put in our next lower low, which is actually at my draw and actually would have hit my TP. Now, had I played my stop loss somewhere where it was protected instead of in the middle of a random candle, my trade idea was correct, and I wouldn't have gotten stopped out. So yeah, there's an example. Let's see if there's anything else in here. There's other reasons why some of these might have lost, but it's still good to go over structurally the idea of what I'm trying to teach you guys, which is a protected stop right now, right? Yeah, bang. Another very good example. Actually, this is the best example yet. This is on eval. I had my shorts target. You can see that we are rapidly displacing down. We're coming down. We put in our lower low. Then what do? We come up here. We put in our higher low into this gap. We retrace, and then we get our displacement out. So I'm thinking, okay, draw is confirmed. Let me take my trade. Let's see if we can smack TP here. But what do I fail to do? I failed to put my stop loss in a protected spot, which would have been up here above the higher low, because this would be a protected stop. I ended up just putting it, in the middle of nowhere, basically. And what happened? I get stopped out before we run straight to my TP. So yeah, I think those were some pretty good examples there. Hopefully that made sense to you guys. While we're at it, if you guys watch this far and you're not in the Discord, go ahead and join up. It's free. Free to join. Everything is free. I give out these signals daily in the mornings for free. Just kind of what I'm looking for going into the day. So yeah, if you guys were not already in there, go ahead and join that. And let's see what we got next. All right, so we've gone over my break-even system. We've gone over take profits. We've gone over getting a protected stop loss. Now SMT. How do I use it? Hopefully you guys already know what SMT is at this point. You should. But if you don't, it is just essentially where, let's see. Let's see if I can sketch something out here for you guys. Geez, hopefully this makes sense. Let me cook real quick. Yeah, this is tough. Okay. Yeah. This will do. All right. So, in case you guys don't know what SMT is, I want you guys to look at this as we have NQ right here, which is typically where I take most of my trades, if you guys didn't already know. And then here we have ES. So NQ and ES are correlated assets, which means that they move fairly similar, almost exactly the same, but sometimes we get this thing called SMT divergence. So that is basically when one of the assets will take out a draw, and then, this would be the leading asset because it ends up taking out the draw. However, the other correlated asset does not end up getting to the draw. So as you can see here, the charts look pretty similar, but ES is the only one that actually gets to our bullish draw here, and NQ doesn't make it, and then they both end up reversing at the same time. And I guess let me try to pull up. I guess I can pull up ES here so we can find a real chart example before I show you guys how I use. Okay, it's going to be kind of confusing because I already have a bunch of stuff written down. Actually, I think, okay, we have an example right here. So as you guys can see, this is good. This is perfect. We actually have an example right here. Hopefully this makes sense and my charts don't look too goofy for you guys. But you can see right here, we have the same draw. We have the same bearish draw marked out on both NQ and ES. You can see that the charts look pretty similar here. They are both trending towards this draw, but you can see on NQ here, we still have some distance to cover before we take this draw. However, what do we see on ES? ES has actually already taken it out. And so what this would mean for me, this is the way that I actually use SMT to manage my trades. Let's just say, and this can happen, you're going to notice this on, we're on the 4-hour right now, but you're going to notice this on other time frames as well. For me, I look for it on, since most of my trades are taken on the 1 minute, I look for it on the 1 minute at our draw on liquidity, right? So if ES takes my draw on liquidity first, and I'm in a trade on NASDAQ here, what can happen? So what can happen? I just showed you there. We can sweep out the draw, and then we get a liquidity sweep, and then we reverse, right? This can happen. And so if I was in a trade right here, what would end up happening, let's say I hadn't gone break even yet, I would actually just end up losing before we get to the draw, even though ES took it. This could be the most probable draw in the world, right? This might, there's nowhere else for price to go. Like, we're definitely going to be bullish. We're definitely going to take out, or we're definitely going to be bearish, and we're definitely going to take out this draw. But, if you get unlucky, ES can take it first. Unfortunately, you entered on the lagging asset. And so price could just reverse and stop you out or break even you, when in reality, if you had entered on the leading asset, you would have been able to hit TP. And so what do I do here? I'm trying to transition to actually just entering on the leading asset. But up until this point, I've only traded NQ. So when ES takes the draw first, this is how I manage my trade. If we have other draws lower that, I'm confident in, I might stay in the trade, right? I see ES take the draw first. NQ is behind. I know that price could reverse, but if we have another strong draw below and, we're looking super bearish, I might think, okay, I'm just going to hold this trade. Hopefully we go lower, and hopefully we do not reverse and break even me. But if we do not have something like that, and I'm not confident in the overall market structure, or we don't have another draw below this draw, like for example, well, I guess this is a good example. This next draw is kind of far away. I wouldn't really be able to hold this right now. What I would do in this case, since ES took it first, I might just decide to close my position on NQ, because this has been tested by other people. It has also been experienced by myself. Price will probably just break even you, and you're going to be pissed that you didn't take profit where you had the chance. It's not full take profit, so obviously that's a little disappointing, but it is better than no profit. So when I'm trading in the mornings, I like to have both assets pulled up side by side just like this. I'll mark out the same draws on both of them so that I can recognize an SMT when it happens. And if it does happen, I'll do one of the two things that I just explained to you guys. You'll develop kind of a better edge for that over time. But if we want to have a general rule of thumb, just exit your trade if the other asset takes it first, okay? If ES takes the draw first, it's probably best to just exit it on NQ. And you're going to see over time, maybe that's not what you're going to want to do. But it's situational, right? You can't make it mechanical. As retail traders, you can't make anything mechanical. and you have to rely on your discretion, right? So yeah. Okay, so the next one, trailing stop loss, is our next topic here. Let me get rid of ES just so that you guys can see better. Trailing stop loss, and as you guys can see, I put this one below the others, right? It's not one of our main four, I guess, what's the word here? Not pedestals, but like, I don't know. It's not one of the four main things that I like to use. It's kind of a separate thing that really I don't touch often, but if you guys are familiar with a trailing stop loss, or if you're not familiar with the trailing stop loss, it is just where, okay, geez, horrible drawing. It is where, you have your trade, you have your TP, you kind of just move your stop loss up as price goes over time. So as price is moving up, first we'll go break even, and then I will kind of, trail my stop loss behind price as it continues getting closer to our draw, right? So I could trail it up a lot, I could trail it up a little bit, but it's kind of just carrying your stop loss along with you so that if price does decide to reverse, you're still guaranteed some profit, right? It's better than a loss, and it's better than a break even. But if you guys don't know, this is kind of something that higher RR traders are doing. It's not something that I would be doing. It's not something I really ever do with my system unless I am taking a more discretionary higher RR trade. So I don't really recommend you guys trail your stop loss at all. The farthest that you should trail it is break even, because typically we are just going for these 1-to-1, maybe 1-to-2 RR trades. And so trailing your stop loss is more often than not going to just prevent you from hitting full TP, and you're going to end up getting trailed out instead of hitting full TP, right? So you don't want that to happen. But I guess I will put this out there for you guys. If you guys are newer, you're going to see, all these different TikToks and stuff. You might see people with a few different orders throughout here. This is kind of a similar idea, but they'll have like TP1, like TP2, and then a third TP, which is like their full TP, where they slowly take profits at each one of these things. It's kind of the same idea as a trailing stop loss, but I would not recommend it. If you are going to trail your stop, here's how I would do it. If you do decide to do it, you should be trailing your stop loss to, similar to, it's the exact same as our the protected idea is still the same. So let's say you get an entry. I'll just use this right here since we have it pulled up. I'll just use this drawing. But if we have a TP, or if we have our drawn liquidity, you take your entry right here. The only place that you should be trailing your stops, in my opinion, is to more protected lows. So originally we have it at a protected low. What do we put in? Another protected low. We can move our stop loss to here. And what do we get here? Another protected low. So we're going to move our stop loss to there. Hopefully we hit full TP. If not, we end up getting trailed out in profit. And so this also kind of ties in, I guess I should mention this ties into the SMT concept as well and how I manage that. I don't know why I didn't go over this. When we have an SMT, I will trail my stop. If I still want to see the trade potentially play out, I'll just trail my stop up to the next protected low. This is how I would do it. Now, in these lower RR trades, you're probably not going to get the opportunity to do it because it's not going to make sense to really do it. Like to go from break even up to, $50 in profit, it's not really that big of a difference. That's one thing that you can do when you see an SMT is rather than closing, you could trail your stop. Okay. If you could miss out on profit, right? Because you could exit your trade right here, right when we see the SMT, or you could just trail your stop and then hope that it plays out, but then you're going to end up not really making any money because you get stopped out here instead of just manually exiting up here. Hopefully that makes sense. I know that I went over a lot of things in this video. As I was making the break-even part, I was thinking, should I have just made this break-even video separate from the trade management video? Same thing when I was talking about stop losses, but I think it's better to just have them all in this one video, I guess, knock it all out at once. You guys can rewatch this video. You can go back and rewatch each part of the video if you miss something. And of course, as always, if you guys have any questions, you can always let me know, either Instagram in the Discord. But yeah, I think this was a good video. It's going to be a pretty long one. I don't know exactly how long it is, but probably around 40 minutes, maybe a little longer. But yeah, I think I went over everything for you guys, and that's how I manage my trades. So yeah.